Welcome to ETFatlas.com, the podcast that helps you navigate the sometimes wide world of ETFs. Here we keep track of nearly 11,000 ETFs from the United States, Canada, and Europe. So if you ever feel lost in the ETF jungle, you're in good company. Today, I'm excited to welcome Gary Antonacci, a true pioneer in momentum investing. Hello, Gary. Could you please introduce yourself and share the story of your trading and investment career?
I began my investment career in 1974, which was not an ideal time to get started. We were in the midst of a severe bear market. So I naturally started looking at other things in the stock market. I focused on gold stocks and commodities and stock options, and built my business around that. I decided I like the investment business, so rather than just have a college degree, I went on and got an MBA degree from Harvard and managed money on the side. I didn't have to ever go find a job after that. I was successful managing funds for my classmates, their families, and one of my professors. I moved back to California. One of my professors moved here to Berkeley, and he wanted to start a commodities fund. He built econometric forecasting models, and I was handling the technical side, looking at indicators and chart patterns, that sort of thing. And turned out after a while that I recognized that what I was doing was actually better than what he was doing. So I figured I'd focus on that myself and decided to manage some hedge funds that were commodity pools. I started surveying the industry to see what other people were doing who were trading in those markets. And I found that there were better traders than I was at that time, people like Paul Tudor Jones, Richard Dennis, Monroe Trout, Louis Bacon, John Henry. So I decided to focus on the portfolio part of things and hire them as traders. And that worked out really well. Over the next 10 years, we never had a losing year. Capital kept growing. We had very little downside and quite a bit of upside. So a brokerage firm took over my business then, and I decided to just do a few enjoyable things for a few years. And then I always kept an eye on what was going on the research side of things, particularly the academic research, because that tended to be more rigorous. And I stumbled upon momentum, the research on that in the early 90s. I was already familiar with relative strength and with trend, so it was easy for me to see how that could be beneficial. But academics were focusing on stocks mostly because they were concerned about the efficient market hypothesis, and momentum flew in the face of it. So they kept looking at different ways of looking at the stock market, hoping that something would change and that they could reject it. And they weren't able to. So basically, the efficient market hypothesis took a hit from that. But I decided to do my own research and figured that there were better ways to use momentum than just applied to individual stocks. After I did my research, I found that momentum could be used effectively, or actually more effectively, if they're applied to stock indices, as well as to other markets. And other work has come out since then that has validated that and gone back several hundred years to show that's the case. So in 2014, I wrote a book called Optimal Momentum Investing. And that was a way to present a simple model to the public, the Global Equity Momentum Model, or GEM. And it would keep people from having to worry about horrendous drawdowns And over the long run, it should give them a better return than what they were doing. But it was not an ideal investment. It was never meant to be. It was just something simple that the public could use. So simultaneously with that, I started working on proprietary models for managing my own assets. And once I had some developed, I figured, well, if I'm going to do the work anyway, um, and people were familiar with my work through my book, that I could offer licensing of those models to sophisticated investors and advisors. And that's what I've been doing the last 10 years.
All right. You started in the industry in 1974, so talk about the baptism by fire. We'll get into the details about momentum in a while, but before that, I wanted to ask you, because you mentioned the efficient market hypothesis. So I wanted to ask you, what's your perspective on that hypothesis, especially in the context of momentum working fine, as we know from the history, at least?
Well, it's not just momentum. Momentum is probably the biggest challenge to it. But even the model itself, there's some vagaries with it, in terms of how low volatility, low beta performs relative to high beta. And now you've had a wealth of research on technical indicators, tactical approaches to the market. Those all fly in the face of the efficient market hypothesis. So in general, the concept of efficient market does make some sense in that there's information that's readily available that everyone can act upon, makes it difficult to get an edge. And so the markets are not easy to beat. So that part of the efficient market hypothesis is beneficial. Also, the importance of keeping your costs low. But the key to that, which I mentioned, is that if the information that's readily available, that people will follow, and not everybody will follow things like technical analysis or tactical approach. So I think for that reason, I'm not a big believer in the efficient market hypothesis other than as a general concept.
All right. It's just kind of an approximation, but it's just a model.
Correct.
How about buy and hold investing? Does it work in your opinion? And if so, under what conditions it is effective, and when might it fall short?
Well, the problem with it is not so much to do with the investment itself. It has to do with people and their psychology. It's not easy to hold through 50 or 60% drawdowns. And people tend to react badly when they, are under psychological stress. So people will sell low and buy high, which is the opposite of what they should do. So that's the biggest problem with buy and hold. Also, buy and hold, gives you a certain set of returns that is actually better than what most people achieve. But there are ways to improve on that. And again, if you're open to technical approach to the market, you can do better than buy and hold, not just in terms of risk reduction, but in terms of your returns as well.
So why do you think the majority of actively managed mutual funds, for example, underperform just the simple passive indexes? And what would you recommend as the simplest alternative for investors?
Well, the biggest reason they underperform in aggregate is the costs. If you're paying 1.5, up to 2% with transaction costs and so forth, versus passive investment where you might pay 3 bips, that's a big difference over time. So that's why studies have shown that investors in mutual funds, stock-oriented mutual funds, underperform those funds by about 2% a year. The best thing investors could do, in my opinion, is to be open to technical approaches to the market. Usually people will apply that only to manage futures. They'll say, okay, I'll put 10% of my portfolio in trend following, and they do that by investing in a managed futures ETF or mutual fund. Whereas technical approach works well with everything. There's no reason why you should limit it to commodities. In fact, it does better in other markets than it does in a broad mix of futures.
And if you had to choose just one single strategy and stick with it for the rest of your life, Gary, what would it be? Buy and hold? Probably not. Momentum? Maybe some multi-factor approach or something else entirely? And what drives that choice from both the behavioral and practical perspective?
Well, I have picked. In fact, I have 97, 98% of my own assets invested with my own models. Not very many people can say that. And I'm a conservative investor, so you might not know that by looking at my portfolio, but there are strict risk controls in place. So I would say the important thing is to develop models to, do the research, or if it's someone else's models, validate the research, to where you fully understand and appreciate it, and then stick with it. Because the biggest mistake that people make once they adopt the models or rules-based approach is they'll overwrite the signals, or if they get into a flat period, they'll move on to something else. And every model, no matter how good it is, will have periods of flat or underperformance versus its benchmarks. So you really have to have a good understanding and appreciation of the long term and keep the big picture in mind to be successful with that type of investing.
So let's talk more about momentum, and let's start with really the basics. What exactly is momentum, if you could explain even to those who are really very beginners? Can you give us some maybe very short overview also of the behavioral basis for momentum and why it works?
Well, momentum means persistence in trend. It's similar to Newton's idea of an object in motion stays in motion. So studies have shown, they validated that things that have done well in the past tend to continue doing well. That's all that momentum is. Now, trend following is a generalized form of momentum in that you're finding ways to identify when that occurs. The most common way of thinking about momentum is relative strength. That's what the academics came up with, back in 1937 and then again in the early 90s. They were just comparing sectors of the market based on relative performance over past periods, and they could see continuation. But there are other ways to identify autocorrelation or trends. So I go through a lot of that on my blog and my website. So we're looking at things like moving averages, channel breakouts, and so forth. There are some complements to that, which people shouldn't ignore, like seasonality and mean reversion. Those are good diversifiers to create a portfolio that can be momentum-based, but that has other factors that can smooth the volatility and increase the expected return.
I can highly recommend to everyone Gary's blog, Optimal Momentum. There's a lot of great stuff, so really I enjoyed a lot reading it. What's the difference between absolute momentum and relative momentum? Can you walk us through each concept with some practical examples, maybe?
Well, relative momentum, like I say, is how people started looking at it. And that's comparing one asset to its peers, and then you go with which or one sector. Like in the early momentum studies, they took the broad stock market and chopped it up into 10 parts, deciles, based on past performance. And they found that the top deciles outperformed the bottom deciles going forward. So that's an example of relative strength or relative momentum. Absolute momentum is when you're looking at an asset by itself and what it's done over time. Sometimes that's called time series momentum, although I think that's not the best name for it, because in a sense, all momentum is based on time series, which is our returns over time. So what that does is it looks at an asset itself and says, okay, if it's gone up over this period of time, then it should continue going up. That's the main difference. Now, there are other ways to identify trend other than absolute momentum, as I said. Uh, there are variations of that. Moving averages are closely related. Both moving average crossovers or penetration of longer term moving averages. Channel breakouts are something that have been used successfully for quite a long time. They were introduced by Dick Donchin in the 1950s and 1960s. Keltner channels are another form of that. Jack Dreyfus became a billionaire using a variation of that, where he would only buy stocks that were making new all-time highs. That's a form of channel breakout. Again, it's identifying strength and then recognizing that there's continuation to that strength.
And on which time frames does momentum work best? Intraday, daily, weekly, monthly, or maybe some longer periods? And why do these time frames matter?
They matter because of the psychological basis behind them. Your last question asked about that, and I didn't mention that. But what momentum basically is an underreaction initially to information. There's either slow diffusion or people are skeptical of that information. So there's lag. But because the markets are fairly efficient, they do respond to the underlying fundamentals. So what happens is after there's a ignoring of the information, then there's a catch-up process. So that is when trends begin. And then you have another psychological aspect, which is the bandwagon effect. Everybody wants to jump on, and that accentuates the trends. Now, for that to have time to play out, you can't be too short-term, and you can't be too long-term. So momentum works best on an intermediate basis, which would be from 1 month to 1 year, typically. Once you get out to 3 or 5 years, you tend to have some mean reversion. And if you're dealing with daily and weekly prices, that's also tends to be prone to mean reversion as much or more so than it is to momentum.
And which asset classes show the strongest momentum effect? Stocks, fixed income, bonds, commodities, currencies. Are there differences in how momentum manifests across these asset classes?
There is. It depends on how you're looking at it, too. That's why I say we use multiple things. We don't use absolute momentum anymore like we used to. We use channel breakouts. We use moving averages. We use seasonality, other things like that, which can identify these patterns. And then you sort of fit the market to whatever. The channel breakouts work almost with everything. It's just we don't use it on all our models because we don't want to have the same approach. I believe in diversification of approaches too. That's why we have seasonality and mean reversion, and also why we use moving averages with one of our models. But as far as where it works best, the last 2 years have been pretty good representative of the markets, I think. So last year, our best models were ones that focused on digital assets and gold. And it turns out that this year it's the same. Although the stock market is coming up fast, that's doing pretty well now too. When I say digital assets, people sometimes shy away and they think, "Oh, you're trading, cryptocurrencies." Well, we do have a little bit in that area, but it's mostly blockchain technology stocks. We use 70% of our digital asset model is devoted to digital technology ETFs. And
all right,
those have been
but do you do just ETFs or some individual stocks as well?
We use ETFs because I like to reduce the idiosyncratic volatility. I don't want, shocks and jumps and surprises to come into my models any more than they already do.
Gary, you mentioned about costs, that high costs is a big problem, for example, for mutual funds. But momentum strategies are quite active strategies, which means that transaction costs and taxes can also add up quickly. So, after accounting for these costs, do momentum strategies still deliver superior net returns? How should investors think about these practical frictions?
It depends what you're looking at. What you say is very appropriate when you're dealing with individual stocks, because momentum stocks tend to be more volatile. They have wider bid-ask spreads. There's very high turnover. In a momentum stock portfolio, you might turn over 25%, 30% of the portfolio every month. So the trading costs are going to be significant in terms of getting in and out of your positions. Now, what we do, even though we use daily data now, used to be I relied on monthly data like most people. Now we use daily data, and but the way that the models are designed, we don't get that many trades. We might get 2 or 3 trades a year in each model. And seasonality, of course, gives more trades if we're looking at what's happening on monthly seasonality. But generally, on trend following, it's not that active if you stay away from individual stocks.
Understand. You mentioned about the dual momentum concept. So I wanted to ask you a bit about it and about the evolution beyond the gem strategy you mentioned before. So let's dive into the heart of your work. I mean, the dual momentum. Could you explain why it's in the first place called dual, and how combining absolute and relative momentum creates a superior approach?
Well, it's called dual because it uses both absolute and relative momentum. And the way it works, as I wrote about in my book, is that to keep it simple, we just look at U.S. stock market, non-U.S. stocks, and intermediate term bonds. So we apply absolute momentum first to tell whether we want to be in stocks or not. So we'll focus on the S&P 500 because that tends to be a leading index for world markets. And we'll say if that's been up, over the past 12 months, then we want to continue to be in the stock market. If it's been down, then we want to be in intermediate term bonds. So that's the simple absolute momentum part of it. Now, the way relative momentum comes in is we say, okay, if it's been up and we want to be in stocks, then where in stocks do we want to be? And then we look at how the U.S. stock market has performed relative to the rest of the world stocks. So that would be developed and emerging markets, except for the U.S. And whichever of those two has been stronger, that's where we want to be. And then each month we reevaluate, and that's basically how my GEM model works. Now, what I found was that that model, over the long run, it's a great model, but it's not as sensitive to shorter term things that happen in the marketplace. And I discovered that markets tend to have more turning points now than they used to. There's more information out there that people readily act upon. So you have more swings up and down. And that was brought home in early 2020, especially where, the market came down quickly and then went right back up. And the same thing happened this year, in fact, to a lesser extent. So I determined then that I wanted to change things around so that they were more adaptive to market conditions. So I started looking at incorporating daily data, and I came up with what I called advanced GEM or AGEM. And with that, because I had daily data available, I could determine the optimal rebalancing frequency instead of it being 1 month like most people do, because all they use is daily data. I determined that rebalancing every third week made more sense. And then I also incorporated another way of looking at trend as far as the markets go. So that was a move forward, but still wasn't adaptive enough as it could have been. So I started looking at other things that I was familiar with, like channel breakouts, using only daily data. And I decided to look at it with the most challenging market I could find for trend following, which was gold. I was attracted to gold because it's that and T-bills are really the only safe harbor when the stock market is under extreme stress. So I thought it'd be great if I could come up with something that worked well with gold. And the channel breakout worked really well with gold. And because of that, I figured, well, it ought to work well with other markets too. And it did. It works well with pretty much every market.
For investors who still use GEM strategy, and believe me or not, but really this strategy is very, very popular among individual investors, retail investors. But sometimes they can use it, for example, due to some accessibility. Would you say that it's somehow after these over 10 years, because the book was published in 2014, is it maybe we could say fundamentally broken, or it's just maybe less optimal, so that after you wrote that book, you noticed that, well, you can do it better. So GEM, maybe it's good for do-it-yourself investors, but if you can still do it better.
Yeah, there are always ways to improve on things. Otherwise, we'd all be driving Model T cars still. So there's nothing wrong with GEM. It's just that it depends on two things to really excel. The first is you have to have U.S. stocks and non-U.S. stocks. You have to have some alternation so that relative strength can prove its worth. And U.S. stocks have been dominant over the past 10 years, other than for short periods of time. The other thing, too, is you have to have sustained bear markets for GEM to really prove its worth. And we haven't had that either. I mean, 2022 was not a great year, but you wouldn't call it a severe bear market. And because 2020 was so short-lived, and this year too, you can't really say that about those either. So we haven't had an environment for GEM to really excel, but it's done a respectable job over the past 10 years.
And by the way, correct me if I'm wrong, but you still provide a track record on a monthly basis for the classic GEM approach, right?
Yes.
All right. And by the way, are there any plans for another book, maybe continuation of the dual momentum investing or something new on the way?
Yes. Now that my model development is over with, and I've just relocated, but after I get unburied from all the things here, like those boxes in the corner, I'll start working again on the new book. I will have probably a slight enhancement to GEM, but my new book will cover a lot more ground in terms of expanding the idea of momentum to incorporate other forms of trend following and other things that might be mixed with trend following, and a lot of information as to behavioral issues and what people can and should do so that they don't get caught up in them, and in fact they can take advantage of them instead of being taken advantage of.
You have models which are proprietary, which are licensed, and I wanted to ask you what drove you to adopt this kind of business model rather than, for example, to run a traditional hedge fund?
Well, it's expensive to do a hedge fund, to start one. When I did the one back in the 80s, it wasn't, you could easily put one together. And now it's plus, attracting capital into a hedge fund. A lot of people in it, might be reluctant to just do that if they haven't seen something first. So this way, people can, because I license the models to sophisticated investors, they can, see what happens with their own accounts. And the business has grown tremendously. So I'm happy with that. Also, I have some pretty smart advisors who recognize the worth of these models, and they've gone and really developed their business using them.
But who's the target audience for your license strategies? Is it mostly the institutions or also retail investors?
Well, I have a foundation as an investor. I have some family office type investors, large sophisticated types. And then I have some smart advisors who recognize the value of it. Some of them incorporate it in with other things they do. And there's a couple of them who just adopted my models wholly and have built their business around them.
But how strategy licensing work in practice? I mean, you provide them signals or they know the strategy and they implement it by themselves?
No, I provide the signals and also monthly reports with information about the markets and the models and how it all fits together.
You mentioned about academic research at the beginning, and I wanted to ask you because also on your blog, there's a full amount of articles based on the academic research, and to be honest, that's the greatest part of your blog, I would say, in my personal opinion, and that you had time in the first place to read all of these papers. But which academic researchers have made the biggest impression on you personally in the momentum and factor investing space?
Well, there's a lot of them. On my last blog post, I give links to articles, research articles by different people. And so in different areas, you have different things like that going on. Like in the momentum area, goes all the way back to Cowles and Jones in 1937. They were the first ones to deal with relatives momentum. And then Jagadish and Titman in the early 90s. And then some of the AQR researchers like Moskowitz, they furthered that along, Hurst and Moskowitz. So that was some of the early stuff. But then you have people that were not academics like Dick Donchin with the channel breakouts. You have Keltner, things like that, that have all lend some validation to it. I'd say if I had to pick a few people right now, one of them would be Gary Smith, who I've done a review of one of his books, and he's written a other book that I should have reviewed, but I haven't had time. But basically, what he is like a gadfly. He points out some of the errors that people make when they look at things by not examining them properly from a statistical point of view. Another person like that is Lopez de Pardo. He's turned out some excellent work in terms of skepticism and critiques of factor-based investing and other ways of looking at things that have not been thought out as well as they could have been.
The core concept of momentum is very simple. Maybe it's even hard to believe that such simple thing can work. But with today's computing power and access to vast data sets, it's easy to build even more, let's say, sophisticated models. But this raises the risk of overfitting to historical data. How do you guard against this? And what advice do you have for investors to avoid fitting traps?
That's a great question, because there is a lot of that goes on. There are websites out there of trading approaches that are basically based on just overfitting limited amounts of data. And people just don't know any better because they look at these hypothetical track records or even real-time track records of a few years, and they don't realize that it's built on a house of cards. You can't really rely on it. So the way to have some more confidence in that is to look at the academic side of things and see what goes back 100 years or more that's held up over that period of time. Now, what academics do is they look at consistency. They don't just look overall. They'll segment the data up and they'll say, well, over decades, how is it done? Or, and you want to look for consistency. You want to look for robustness. Does it apply to different markets as well as over different time frames? You want to ask, does it make sense? like we have some behavioral explanations for some things. For other things, it's hard to come up with some explanations for it. And you want to look for real time validation too, because even on the academic side, you can end up with selection bias, or uh, there are ways that uh, people can just come up with something that unless it's replicated, you're not going to have complete confidence in it. So you have to apply a lot of these kinds of tools that most people don't pay attention to. The typical investor just says, well, what has it done over the last 3 years or 5 years? And that's the worst way of looking at an investment. Absolutely the worst.
Yeah. So why do people struggle to follow rule-based strategies, based, for example, based on momentum, even when they have statistical significance? What psychological barriers get in the way?
Well, it's one is that they just don't understand what they're doing, well enough. They haven't studied the research. They haven't, really gone through it to where they can see that there will be some fluctuations, but over the long run, it holds up. That's one thing. The other is they just get influenced by other things, like something might come along that's doing really well, and they'll jump onto it and think, well, this is doing better, so let's go with that. That just happened this week. Somebody stopped using one of my models because he was into Nvidia and some other tech stocks that were going gangbusters, and he thought, well, why should I stay with a model that isn't making over 100%? He for, forgets the fact that last year the composite of all our models, which is what I use, was up 47%, and this year, we're doing quite well too. But we're not going to make 100%. But I'll bet you he's not either. Certainly not over the long run.
Right. And do you think that rule-based approach, a systematic approach to investing, it's easier to be successfully implemented rather than discretionary approach? What's your take on that?
Well, that's one of the advantages of having a rule-based approach. You don't have to try to guess what's going to happen next. You just follow the rules. And I follow the rules exactly. Even that's another thing. Sometimes you'll see a signal to get out of a trade or to get in a trade, and you think that's crazy. Why would I want to do that? But I just say, okay, it's crazy, but I'm going to do it anyway. And more often than not, it's the right thing.
You wrote your book in 2014. How has the investment landscape changed since you introduced that book, Dual Momentum book? Are there any new challenges or opportunities?
Well, it's interesting. When I wrote my book, I actually went to speak at a national investment conference then, and hardly anybody knew what I was talking about. It was like it either went over their heads, not that it was complicated, but they just weren't used to thinking along those lines. And they just invited me back to speak again a couple months ago, and everybody knew what I was doing. It's like everybody knew about momentum and relative strength and, trend. But I like to think I'm staying ahead of the game because, I have different ways of doing it now. And I'm free with as much information as I can be so other people can move along in that same direction. And the markets do change some over time. So you do have to be cognizant of that. But at the same time, everything I'm doing has worked, almost back to the time of Genesis, if you want to go back. So on that basis, it's just a matter of being receptive to the work that's already been done and, identifying it and incorporating it in a way that makes sense. The other thing that's important is portfolio structuring. uh, people give short shrift to that. They don't realize the importance. But I think Harry Brown was onto something back in the 1960s, where he came up with his permanent portfolio, where he had a quarter in stocks, a quarter in bonds, a quarter in gold, and a quarter in T-bills, which is kind of a drag now. So we do something similar. We have models for stocks, bonds, gold, and digital assets, and then every one of those models can end up in T-bills during a risk-off position. But what we also do, which is unique, is model layering. So we might go from one model to another rather than just go right into T-bills. So that adds to a potential return for what we do.
And what's your view on the current market environment? I mean, in the context of momentum, are there any specific opportunities or risks that momentum investors should be aware of? For example, AI.
AI, just like everything else, gets incorporated. Companies are uh, incorporating that as much as they can. You've got a lot of the tech companies are, highly involved with it. So that gets incorporated into what we do. I will say that when you're applying trend or momentum to the stock market, a lot of people just think, oh, S&P 500 or Russell 1000, something like that. But it actually works better when you're dealing with large cap growth stocks. And if you think about it, you can understand why. Because if you're truncating the downside and you want to capture the upside, you want things that are more volatile, that are going to respond more to the market on the upside. As far as my view right now, I try never to have a view, basically. But my models are all risk on at the present time. The bond model, the digital model, the stock model, and the gold model. They're all in a risk on state. Gold models showing that, little loss of momentum. It's gone into consolidation. So if we do end up getting out of that, which is a possibility before too long, we would flip into the stock model. That's the way that structuring is set up.
In your latest article on your blog on why investors underperform, you mention your just quoting very best timing indicator that has worked dozens of times over the past 50 years with no losses yet. So I just wanted to ask you about that. You describe it as observing when investors abandon models, your models, for example, to chase other strategies, at which point you increase your own allocation. When they just walk away from that, you just put even more money on it. Could you elaborate on this behavioral indicator? How do you systematically maybe track this sentiment? And why do you think this contrarian signal has been so consistently reliable?
Yeah, well, it's hard to put more now on it because I have 97, 98% of my assets invested, but that's because somebody just, exited. So, but it's worked. It's not just when they jump onto something else that looks more attractive. It's also if we ever do go through a drawdown. I mean, our drawdowns are pretty mild so far. But if we do, and, they also bail at that time, that's another time when, you want to mortgage your firstborn and, do something additional. And the reason is it's basically tracking the movement of money from weak hands to strong hands. And if somebody bails, that means a lot of people have that same mindset, and it shakes out all the weak players, and people take their place who understand things better and who are not going to get shaken out, like me, and others. So that gives a stronger basis for continuation when things do turn around. And also there's mean reversion, of course, that goes on. So if you look at some of the strongest market moves, that happens either after long consolidations where you have a base building and when people get impatient, or after uh, the markets have been knocked down and people lose confidence and, go and, raise cash. That's usually when the market, because there's no one left to sell, basically. Everybody's gotten out who's going to get scared out. And then the market has nowhere to go but up.
Understand. For someone just starting the momentum investing journey today, what would be your top 3 pieces of advice?
Well, one is to keep open to a technical approach to the markets. Look into those and incorporate them into what you do. They can be applied everywhere, to stocks, bonds, whatever assets you have. There's no reason not to use them, basically. You'll have maybe some tracking error once in a while, but that's a reason for having a diversified portfolio. So that's the second thing I would say is diversify. Don't just be in one thing or one model. And the third thing is, I would say, is stay with it. Just try to understand things as best you can so that when the noise happens, you don't get drowned in it.
Is there one thing about momentum investing that you think most people misunderstand? You already have some experience also talking to people when you were running and you're still running your blog, so probably you have plenty of comments. So is there such thing which is most people misunderstand about momentum?
Yeah, they don't understand how effective it is. Like some people will see that I have a model called what's it called? Blockchain and Digital Asset Synergetic System. That's BADASS. And people look at that and they say, "Oh, crypto! I don't want anything to do with that. That's where crooks and thieves participate." And they don't understand. First of all, we have small positions in Bitcoin and Ethereum. Most of it is blockchain technology stocks, and we have all kinds of risk controls there, so that we have less downside there. We've had less downside there than people usually have in the stock market, and potential for considerable upside. So you just have to get out of your mindset of biases and prejudices, and also a familiarity bias where you think stocks and bonds are where you want to be. People who, most people recognize they don't want to be 100% in stocks because they don't want to go through 50, 60% drawdowns. So they might have a good portion, especially as they get older, in bonds. And they don't realize that puts a serious drag on their portfolio. So trend is a really good alternative to that. It can give you the downside protection, assuming everything works the way it has and should. And at the same time, preserve your upside.
Any final thoughts for our audience who are interested in implementing momentum-based strategies, maybe?
Well, go to my website and you'll see some
optimalmomentum.com, right?
Yes, you'll see some blog posts, and my book's available there. And there's a page called Proprietary Models. You can see what's been going on there for us. I've really put my life's work into developing those models, and they're performing well.
Gary, thank you so much for sharing your insights and stories with us today. I hope our conversation gave our audience a bit of momentum for their own investing journey. And if not, at least we didn't lose any relative strength along the way. Wishing everyone strong trends and calm markets. Until next time.